You know that feeling when you check your portfolio, expecting a little lift, and it's just flat? That's where I've been lately with SCHD. I bought it for stability and steady dividend income, but lately it feels glued to the floor while the market soars. If you're holding SCHD, you've probably wondered, is it broken? Has something gone wrong with this fund? I want to show you why there's real data behind this lag. Let's start with the biggest force in the market right now. That gravity is the Federal Reserve's interest rates, the single most important reason the fund looks weak today. Imagine you've got $1,000 to invest. A few years ago, safe income options were limited, and treasury bonds paid next to nothing. People turned to dividend-paying stocks like SCHD, viewed as bond proxies with higher payouts and growth potential. Then inflation surged, and the Federal Reserve aggressively hiked interest rates. Suddenly, government bonds became attractive again. You can now buy U.S. Treasury bonds with nearly a 5% yield, risk-free, and backed by the U.S. government. SCHD holds high-quality dividend-paying companies, but stocks always come with risk. Why take that risk when you can earn 5% safely? You've got ultra-safe government bonds waving a guaranteed return in your face. On the other, you've got SCHD, a portfolio full of proven companies with uncertainties. The decision really depends on your time horizon and your tolerance for watching the market do its little dance every day. SCHD's strength lies in what can't be seen from a single month or quarter. These companies have real earnings power, generating cash year after year. They sell products people use every day: toothpaste, broadband, oil. Things that don't vanish in a market correction. Income investors are chasing the sure thing. It's not that SCHD became risky. It's that the baseline for safe returns moved higher. Humans crave safety. A guaranteed 5% feels comforting in uncertain times. But inflation slowly erodes that return over time. Dividend payers provide growth that bonds don't offer. Dividends can rise and share prices can appreciate, leading to massive long-term gains. From a short-term view, bonds seem like the easy win, but SCHD plays a longer game. It rewards those who understand time in the market beats timing. When interest rates drop, the bond yields will shrink. Investors seeking safety will start searching for better opportunities, leading them to SCHD. SCHD's current underperformance is setting up for potential outperformance. It attracts the quality cash flow and consistency investors seek. Investor fear turns into greed, and market leadership rotates. Back in the early 2000s, tech stocks ruled. Then, value took over. In the 2010s, growth made a comeback powered by low rates and innovation. Now, we see another tech-driven surge. Nothing in markets stays dominant forever. The narrative shifts quietly at first, often unnoticed, until halfway through. SCHD sits at that turning point. It's not flashy, but it's preparing for the next phase, consistently raising dividends. When rates fall and growth hype cools, that pent-up reliability becomes momentum. Investors have short memories. When risk-free bonds yield less, funds like SCHD will look irresistible, with a 3.8% dividend yield and growth potential. SCHD's design rewards patience. Its rules ensure only profitable, financially sound companies are included. When the market mood shifts, it benefits from fundamentals like earnings power and payout stability. I think of it like a tide going out and coming back in. What looks stranded will come back to life. SCHD has been waiting for the tide of capital to return. When it does, the move could be sharp. In moments like this, patience isn't passive, it's strategic. Investors who hold through will end up on the right side of history. Patience in investing isn't about doing nothing. It's about understanding what you already own. Compounding takes time, and that time is the advantage most people waste chasing the next big thing. SCHD rewards those who can sit still when everyone else is jumping ship. Each dividend check proves the strategy is still working. Investing isn't about what's hot right now. It's about owning what endures. SCHD is filled with businesses that endure. If I can get 5% from a treasury, risk-free, I need to ask, what's SCHD giving me for that extra uncertainty? I'm buying exposure to great companies that can grow their dividends over time. That growth justifies the risk. For many investors, especially retirees, that steady 5% from the government is like a siren song. It's safe, simple, and stable. SCHD can be frustratingly slow right now. It's like watching grass grow while your neighbor's garden is exploding with flowers. The truth is, risk and reward are always a trade-off. I can play it safe or invest in companies generating profits. I'd rather own something that can evolve than something that just sits still. The potential for growth is key. For SCHD to be attractive, its dividend yield must compete with that risk-free 5%. The yield is calculated by annual dividend over price. The only way for the yield to go up is if the stock price goes down or stays flat. That's the market reality. The market has established a price ceiling for SCHD due to income investors seeking safer, higher-yielding alternatives. The gravitational pull from interest rates suggests SCHD's price will remain capped until the Fed signals a rate decrease. While SCHD is capped, tech stocks are thriving. The S&P 500 shows nearly 20% annualized return, driven by a few mega-cap tech companies. Companies like NVIDIA, Microsoft, and Alphabet have propelled the index higher by leveraging advancements in artificial intelligence. SCHD's rules prevent it from capitalizing on speculation. Companies must meet strict entry requirements, including 10 years of dividend payments. Companies like NVIDIA or Tesla don't fit that mold. They're reinvesting every spare dollar into growth. They're not paying dividends, and they're not trying to. SCHD automatically filters them out. It's built to find mature, stable companies that have proven themselves and can share profits with shareholders. While the AI boom has driven the S&P 500 to new heights, SCHD has been left sitting quietly on the sidelines, sticking to its discipline. If you've been holding SCHD during this tech-driven period, it's felt frustrating. It's underperformed, but that's by design. The SCHD you hold today isn't the same one you owned last year. It has undergone a massive transformation under the hood. Every March, SCHD rebalances its portfolio based on its rules. Completely unemotional, purely mechanical. This year, that algorithm kicked out 23 companies and added 23 new ones. That's a 20% turnover, for a typically stable ETF. And the changes it made were telling. It removed some popular names, not because they were bad businesses, but because their stock prices had soared high. SCHD's algorithm looked at that and said, "You're no longer a high dividend stock, you're out." It also dropped companies like Pfizer and BlackRock, probably because they failed one of the financial health screens. On the flip side, it added names like Hershey, classic, steady consumer companies, and made a huge move into the energy sector. Energy is now SCHD's largest sector, making up nearly 20% of the portfolio. That's a major shift. Now it's tilted towards cyclical energy companies like ConocoPhillips, whose performance is tied to the health of the economy. SCHD's personality has changed. It's not just the quiet defensive dividend fund, it's got more cyclical exposure now. If oil prices rise and the economy stays strong, this could be a huge advantage. But if energy prices fall, it could sting. When I first realized how much SCHD had changed, it surprised me. I'd always thought of it as a slow, predictable, conservative play. This rebalance really shook things up. It's not necessarily a bad thing. It's just different. We need to understand what we actually own. SCHD's price has been held down by interest rates and left out of the tech boom, now carrying more energy exposure. What does this mean? I don't think it's time to sell. I believe SCHD might be setting up for a recovery, and here's why. The first reason is market cycles. Leadership in the market is cyclical. Tech doesn't dominate forever. Rotations between growth and value happen. The second reason is monetary policy. If the Fed's interest rates start to come down, SCHD's yield of around 3.8% looks attractive. Income-focused investors flood back into dividend funds. Prices rise, yields compress, and we see steady appreciation that's been missing. Morningstar rates SCHD as one of the best dividend funds, calling it sensible, transparent, and risk-conscious. Three main scenarios for SCHD. First is a soft landing, where the economy cools and the Fed can cut rates. In the second scenario, strong economy with sticky inflation, SCHD's performance remains muted, but benefits from strong earnings. The recession scenario would likely cause SCHD's price to fall, but it could still outperform the overall market. A bottom-up analysis of SCHD's holdings looked at Wall Street's 12-month price targets for every stock inside the fund. The average implied upside is 10.8%. Analysts believe the companies in SCHD's portfolio are undervalued and have room to grow. SCHD isn't broken, it's compressed. Factors like high interest rates, the AI hype cycle, and its portfolio shift explain its current weakness, but don't define its future. When rates eventually fall, and when the market rotates back to value, SCHD will likely come back into favor. Until that turning point arrives, long-term investors are holding their ground. SCHD was never meant to be a get-rich-quick play. The dividends continue to flow, supported by solid fundamentals. Many see it as stored potential, waiting for the right moment. SCHD looks weak right now, but it's resting, recalibrating, and getting ready for its next leg up. I want to already be in the game, not chasing after it once it's already moving. Are you holding, buying, or selling SCHD right now? Drop it in the comments. Let's talk about it.